let's say you have the best cricket players in the world, but even if Virat Kohli works with a coach, you see Instagram reels and news alerts.
That's correct. Yeah.
Is neither data nor information. All my life goals and life needs are around the India rupee underlying and the Indian assets, and that's acceptable too. I think the question is, don't do global because you like global. Really started to become what's likely to be a top 3 economy in the world. More than 90% of individual investors actually lose money, and resilience is only developed when practiced. Investing is very important. Investing in yourself is even more important.
Absolutely.
Right?
Very interesting point. When the money comes so early in life, what habit of wisely investing the same doesn't form?
Starting early is never a bad idea. I started my first stock I bought when I was 12, or invest in when things look very good. So this can only go up. The moment you start feeling this can only go up, it's very likely going to go down. Is your money working for you? Or are you working for money?
India is entering a rare moment in its economic journey. Over the next decade, nearly 100 million Indians are expected to move into affluent category. And this wealth is different from what we have seen before. It's not inherited. It's not slow building over generations. It's first generation wealth created by professionals, entrepreneurs, globally mobile Indians, and families whose incomes are scaling faster than any generations before them. But history shows us something very important. Every major wealth boom creates opportunity and risk. Money often arrives faster than understanding. Choices multiply, advice gets louder, and without the right judgment, wealth can become fragile long before it becomes lasting. So, the real question isn't how much wealth India will create, it's how wisely this wealth be managed. Our guest today has spent decades at the intersection of Indian growth and global finance. Sandeep Batra, he is an IIM Bangalore alumnus and a career banker who has worked across India and international markets and institutions like Standard Chartered and Citibank. Today, he leads international wealth and premier banking at HSBC India. At a time when the bank itself is sharpening its strategy and re-establishing relevance with India's affluent and globally connected customers. Having operated at the crossroads of Indian growth and global finance, Mr. Sandeep brings a rare perspective, one that blends local realities with global discipline. Under his leadership, HSBC has expanded its branch presence after a long hiatus, sharpened its wealth strategy, and re-established relevance with India's affluent and globally connected customers. Inside the industry, he is widely seen as a key driver of HSBC's renewed India momentum. This conversation is not about products or predictions. It is about behavior, judgment, and the long arc of wealth creation. Sandeep, welcome to On the Point. Finally, we get to catch hold of you, amid your so very busy schedule, because you're only seen opening new branches, whether it is with, the CMs of the states or who's who of the state, you're actually a poster boy nowadays. So thank you so much for coming on to the point. And it's been a privilege to host you.
Brajesh, absolute pleasure to be here at On the Point. We opened in some of the new cities, but that's not all what we do. We do a lot of things in HSBC, as you know, and it's been around in India for 170 years. And through those 170 years, we've been a part of the India story. So you made a great point about opening new cities. But, one of the interesting things we did last year, we also celebrated 100 years of our branch in Calcutta. So the same year, we celebrated 100 years of being in Dalhousie at Calcutta.
Wow.
And in the same year, we celebrated day 1 of our branch in Amritsar. So
Excellent.
It's day 1 and it's year 100.
Oh my God. Such a diverse experience, So 1 to 100 types, Wonderful, wonderful. So Sandeep, I'm sure this is going to be a very, very interesting conversation, and especially picking up the perspective of you as a personally as a global Indian, also even as a career banker. So we will just simply start with the show. So we'll start with the first question, Sandeep. As you know, there are plenty of reports out in the market that India will have at least 100 million new affluent customers in the next decade or so. And so, in your experience, what is basically the advice you want to give that they will have money faster than they've got the investment experience, or so to say that investment wisdom. So, what do you think when the money comes so early in life? What habit of wisely investing the same doesn't form?
Right. Brajesh, you make a great point. I think we're all privileged to be in India because it is a country which is among the fastest growing economies in the world. We've all seen that evolution since the country started to open up to investments, to actually started to become what's likely to be a top three economy in the world before the turn of the decade.
Yeah.
People estimate that we have $1 million millionaires in India already, 100,000 of them being formed every year. So clearly a lot of wealth creation. And the wonderful thing is that wealth creation is happening in the metro cities, but also outside the metro cities. Absolutely. Because of now digital connectivity, 5G, artificial intelligence, e-commerce, growth is happening all across.
Absolutely correct.
And that's wonderful. And the capital markets are well developed and they're buoyant. And so the whole space of whether you develop money through entrepreneurship, through private equity, whether through working hard, there's wealth creation which is happening. But you made a great point about what are the traits of investments. I think you actually see a lot of good conversation on that side happening. So whether the whole SIP journey and the SIP movement in India has been wonderful. I think whether it's a promotion from AMFI or people understanding it themselves, whether it's diversification, I think people have started to come around diversification, but it's easy to get distracted around diversification. And whether it is the power of compounding, I think all three of them have started to get settled. But obviously there is a temptation to make your money too quickly. I think it's easy to compound and easy to say the long course, but it is also tempting. And over the last couple of weeks, as you've seen the commodity cycle play out, you've had a dramatic run up in both in gold and in silver. Silver even more amplified, and then you see the sell off, and then you can see a lot of people losing money because either they had leverage or they did not have leverage or whatever. So do it yourself is great, but I think working with advisors is also equally important. You could be wonderful. Let's say you have the best cricket players in the world, but even a Virat Kohli works with a coach.
Absolutely, that's a very interesting point.
And so you should educate yourself. You should invest in products which you understand. You should diversify, but you should also work with a coach. And the best athletes in the world have no shame and are not shy of working with a coach. Because the coach gives you equidistance, the coach gives you reflection, the coach actually partners with you and works with you in good cycles and in bad cycles. So that's my.
So you're saying that especially to the young affluent customers who will have money faster than their experience. So the coach is very, very important. So the financial coach or financial advisor, it's extremely important because I've seen, Sandeep, especially in the young professionals, there is a FOMO, right? And out of that FOMO, there is a peer pressure as well, because people are jumping into commodities, F&Os, etc., etc.
Right.
You and me knows that, how double-edged sword they can play,
right.
So that's where I think from a perspective of experienced people like you, that is where I want to reach out to them. While you see a lot of information, you see a lot of app, you'll see a lot of fizz around it. It's not that, kind of, it's easy to lose as well.
Correct, and you made a great point around futures and options. I think it's a well-developed industry, but based on research which has been in public domain, more than 90% of individual investors actually lose money.
Yes.
So you lose time, you lose sleep, and you lose money. And the chance of losing is 9 on 10. And if you know that the chance of losing money is 9 on 10, and the chance of making money in a well-diversified over a period of time is very high. And what should you pay? But I don't blame anybody. There's always a temptation of trying to do it quick. But since we've been children, we've been told a slow and steady wins the race.
Absolutely.
And that's true in wealth management.
Absolutely. So that fundamentals have to kick in.
The fundamentals have to be in place, and also understanding what are you investing in, and what is your investment hypothesis.
Yes,
right?
Absolutely. So to say of life, at least, whatever if you're doing it, you should have a goal-based kind of a plan or whatever. Great. So Deep, थोड़ा parents की बात करते हैं, ठीक है? Especially we have seen in India, parents play a huge role, taking the financial decisions.
Yeah.
And we have seen especially the Indian parents, even up till the age of 25, 28, or at times even 30 years of their kids' age, they take financial decisions. So do you think this, while they have all good intentions, they want to make sure the money is protected, etc., as growth, but do you think somewhere it kills the financial independence as well of their children?
See, I think it's a little personal for each family and each person and each situation. But at the same point of time, allowing people to make your mistakes is important.
That's correct.
But as a parent, you have to also you want to be able to use your life experience. And I have a 15-year-old, and my 15-year-old has ideas on how investing should look like or how life should look like. There are things you partner with, there are things you walk with him. But there are also spaces where you have to allow him to make his own mistakes. I don't think there is one age where you have to leave the hand and let the guy be or let the person be. I think we have to all make our best decisions. But ultimately, I think your point is well made that everybody has to stand up for themselves, because ultimately in parenting, one of our roles as a parent is to create an adult. And not to extend the childhood, right? And so what makes an adult? What makes the power to make a decision? What makes it's acceptable to make a mistake? What will teach the child resilience? And like in life or in careers, in financial markets, there is the need for resilience.
That's correct.
And resilience is only developed when practiced.
So you're saying over-involvement also kills. I mean, there is somewhere balance. It's very difficult to manage a balance, but somewhere it has to be. It should
be partnering in a sense of balance.
Absolutely, yeah.
But also, see, each life situation will be different. There could be a family. It could be a family office, and you tend to take decisions together as a family office. Yeah. You may be relying on a professional, but you're a family and you take decisions together as a family, and that's perfectly fine.
That's good.
You could be in a situation which is a family-run business, and again, financial decisions may be taken together, and then again you have to a little bit decide where the primary decision lies and where is there ideation and when there is collaboration. But there's also people. Let's say the child is starting out his corporate career. You have to allow the child to be able to be his own person, and so which is why I said, one life situation is not the same as the other.
That's correct.
So I would kind of resist the temptation to give a single answer, and which is why in wealth management I started with the concept of a coach.
That's correct.
Because and the more the coach knows about you, the more your financial planner or your financial advisor knows about you, the more they're able to bespoke their advice to your life situation.
That's correct.
So like in medical science or in the legal profession or in financial profession, the more you share, the better advice you'll actually get.
Absolutely. Maybe they can limit the exposure of the amount of investment they will do. I mean, you take decision up to this, there is a cutoff of the finance you will play with. Balance, if there is a goal which is much more serious in nature, maybe take the help of your parents or coach. Definitely.
I think in my view, the coach, you always do well when you deal with a coach who is independent, who is able to see you from a distance.
That's correct. He'll be dispassionate, Yeah.
It's important because, in investing, while knowledge is important, the emotional quotient to stand through the investing cycles, because the investor, it always feels this time it is different.
Yeah.
But the investing cycles are real.
Absolutely.
And when the markets are in your favor on decisions, or recent decisions have been in your favor, It may give you a little bit of a sense of overconfidence, or it may give you a sense of, listen, I kind of really know how to get this right. And when markets are bad, you may punish yourself a little bit more
That's
than what you
correct.
need to.
Absolutely.
But a good planner and a good advisor is able to see through cycles and be able to labor through those cycles.
Absolutely.
And eventually see the returns.
Yeah, because when you lose money, being a child psychology or whatever, adolescent or say young psychology, you tend to get scars on your mind and then you'll fear.
All of us, yeah. If you look at your portfolio report for the last year and it doesn't look good,
absolutely,
it's hard to feel good about a difficult year.
Yeah.
At the same point of time, what's your benchmark? What are you comparing against? What's your longer term return? Now, if you just started out and you started out in a difficult, like look at the last 18 months, returns have been slightly below what long term averages look like.
Yeah.
If you were only investing in one asset class.
That's correct.
But again, returns may have been great. So, for example, in HSBC, we launched or relaunched the Emerging Markets Fund.
Yeah.
The last 6 months return IRRs are very healthy. They are north of 50% because the emerging markets did very well. Right? Korea's had a phenomenal run. And similarly, at this point of time, we just announced the two important trade deals, the European trade deal and the US trade deal. The markets are rallying this morning. Yesterday it looked gloomy and today it looks very bright.
Like all different.
So emotion, as long as one can keep the emotion at a point of neutrality while letting the good and the bad data come through.
Sandeep, let's talk about too much of an information flow. I mean, everything is available on tap now, on your fingertips. Gone are those days, 10 years, 20 years back when we had to actually relate to or find out the secondary research for what is company doing and all that, Bloomberg, all that stuff. But now anything is available. Information is free flowing. Advices are free flowing, and there are money gurus available every nook and corner. So do you think somewhere this too much flow of information, kind of dilutes the judgment part, which actually comes over a period of time?
You see, Instagram reels and news alerts.
That's correct. Yeah.
Is neither data nor information, right?
Yeah.
That may be a distraction, right?
Yeah.
And if you ask people who directly invest in equity classes, did you actually read the balance sheet of the company and the annual report? Or did you respond of 4 data points or yesterday's technical trigger? Right? Yeah. And I think, so if you choose to be a direct investor, do you know the underlying business?
Yeah.
Are you really acting as a part owner of a very large business?
Yeah.
And therefore you know the business and you believe in the business and you want to become an equal part of it and be a part of that cycle? Or are you just buying off a news flow? Right?
Yeah, absolutely.
And that's very different, right? Because, and what price are you buying that business at?
Yeah.
So are you happy paying 15 times of earnings this year? Or are you ready to pay at whatever price or 100 price? A business which is declining is very different than the business which is growing.
That's correct.
Which is why, but sometimes when you invest in funds, again, are you only looking at the recency of the last 12-month performance? Or are you looking through the cycle? And that there is a temptation to invest only based on the last 12-month trading returns. And when you actually talk to fund managers, what you will find, you see the 25 years of fund performance of a fund, but you look at individuals who made money of that fund, individuals make lesser return than what the fund is returning because there is a temptation to buy when things have really gone up.
Yeah.
And there is a psychological, just I want to exit this because it's not been working out for the last 2 years. I am tired. I want to get out. Right. And but again, what funds are you buying? Do you understand the difference between a flexi cap and a multi cap? What are you looking at the fund manager? Where are you looking at the brand? If you're investing in venture capital or unlisted companies, are you doing it because it's cooler or do you really understand the business?
Correct.
Right.
No, that's what Sandeep, you made a very interesting point about the reels, Instagram reels, because that's where all these young Gen Z people basically are getting influenced, so to say, and then taking financial decisions. It is like, don't you think it's like playing a casino? Like someone is telling you, I made this money and, you should also do that because you just gave a very elaborated kind of response, which is very, very technical in nature. So what is basically happening here is that people are ignoring that fact that making money is very, very difficult and a process-centric approach, it's...
And see, you may want to take a simplistic way of investing, and that's all right, as long as you understand what you're investing in. For example, if you wanted to invest in the restaurant which is below this building, and if it was listed, if you understood what are the sales, what are the returns, what is the rental, what are the employee costs, and this is the profit, I like the business, and I like the business because I feel it's being sold for a fair price and I want to invest in it, that's fine.
Absolutely.
You say, listen, I wanted to invest in HSBC mutual fund because it's been in India more than 25 years. It's a part of a group which is more than 170 years. The returns over a period of time have been the right quality, and that's all right, right? But as long as you are, so either know the business and do direct investing, and that's all right. Choose a fund manager and knowing the underlying, that's all right too. All I'm saying is stay away from just recency of returns, or stay away from investing based on a 15-second reel. I look at Instagram to entertain myself, not as a source of investing advice. But if I find about a business, even at Instagram, I figured that there was a dog grooming business, and assuming it was listed, and I wanted to research that business a little bit more. I must use proper tools to research the business before making the financial investing. Financial investing is one of the most important decisions you make about your life. And you have to have some conviction. You can, again, if you're an investor, you can have forward-looking assumptions. See, the balance sheet and the earnings will give you information at this point of time. Very likely it will also give you information on what is the management thinking about. You could actually, and now because you spoke about data transparency earlier, you are mostly able to find recordings of investor relation calls. But investor relations call typically run an hour. And you really wanted to make that. Are you happy to spend that hour getting to know the business? Which is why if you make a few decisions every year, keep diversifying, but keep making a few more decisions every year. You will have the time, the energy, the effort to know the business. You are able to explain that business to people. For example, if you love AI and you say, listen, I use this particular large language model to query. But you understand who supplies the chips and who's the underlying measure, you do a better role, right? But you have now data and tools to be able to help you ideate.
Absolutely. Interesting. Very interesting point, Sandeep. Let's talk about now digital banking, so to say. I mean, banking on an app or whatever. Today's young professionals, actually, they need seamless experience, and they are doing whatever transactional based banking, so to say. But do you think in the long run, when the life actually throws up your difficult, or so to say, not difficult, important goals of life, like if you have to go for an overseas education, or you want to get married, you want to take a house, I mean, these are all important goals of life. So where do you think the physical branch or a physical interaction, so to say, versus the digital experience, where is the trade-off, and where do you think, what triggers the physical connect versus the digital kind of an experience?
See, one is the person himself or herself, right? There are people who love, I'm a do-it-yourself person, I'm an app person. It's your age, I have a 15-year-old son who's likely to be more digital native potentially than my mother, who's also an active user of banking and financial services. So it's a person, it's the life stage. But it's also a physical footprint where you want to go. We are social beings. If you remember in COVID, all of us or many of us were locked into rooms.
We were forced to adopt that behavior.
But what was the hypothesis then, Brajesh? Right? If you spoke to anybody in the middle of COVID, they will tell you travel is dead. Oil prices were near zero.
Absolutely.
Right? Hotels are unlikely to come back. Malls won't do well.
Absolutely.
E-commerce would only do well. Now we're sitting in 2026. Hospitality is booming. One of the best performing stocks in India has been Indian Hotels. They're on the Taj brand.
Correct.
Airlines have been doing extremely well. Oil's come back. New sources of energy have come in.
So it's a vengeance consumption.
Traveling. And I think there was revenge. But now it's normalized. See, you and me could have had this conversation over a screen, but the energy, the flow, the conversation happens in real life. So at the same point of time, cycles will come and cycles will go. But when you are thinking at that moment, it's very difficult to sometimes believe that the cycle will go back to normal. And so you make a point on the physical versus digital. the energy of a real life conversation is the energy of a real life conversation. A physical footprint also allows for trust, for conversation, for a family to come together and have that chat. Digital is typically one person against the screen and against the service provider.
Yeah.
But again, both are equally important. I think digital will continue to scale in the world. But I don't think there's any replacement of human energy.
Wonderful,
Yeah.
wonderful. So you think the physical branch presence, so to say, in your context of things, it adds trust somewhere, or it shows some commitment as well?
I think there's definitely commitment and trust. So we are going from 14 cities to 34 cities. Our asset management business is already in 50 cities in India. So you want to be nearer to the client. But at the same point of time, you want to do what's convenient to the client. You're happy to meet him or her in his office or residence. The client may want to come to you and have a chat.
Sure.
That service could be met digitally. Now think about the more difficult life discussions, succession.
Yeah.
Which one of us wants to talk about mortality or how we manage our assets after we're not there? It's a difficult conversation to have. Right? You think about, you spoke about life stage planning. Some of the DIY journeys may be available for simpler products. But if you want to invest in a product which locks in your money and takes it away for 7 years,
absolutely,
are you really prepared to do it digitally?
Absolutely.
You think of sending your child overseas and you want to diversify in currencies. You want to know what's really happening at Gift City, which is a thriving wealth center in India now.
Absolutely.
Those conversations are best held with experts face to face.
Yeah.
But there is enough space for a routine transaction to happen digitally. You wanted to subscribe to a fund, you wanted to redeem a fund, you wanted to top up, you wanted to change your SIP amount, you want to transfer money from point X to point Y.
Correct.
In India now 20 billion UPI transactions happen in a month. It's powerful. There is no need for a check to make that payment. So enough space for digital, but there is space for real life.
So just to be clear, so you're saying transaction can happen and will continue to happen digitally. They add scale, they add speed, they add super efficiency. But whenever it comes to investment, and especially for an important goal of life, a physical interaction or a presence, or that is very, very important.
Yeah, I think, again, it's dependent on what you're investing in, depending on your comfort of the investment underlying. But there is space for both. There is definitely the need for the advisor. We've been hiring people to be relationship managers. We've been adding physical footprint.
Yeah.
I think the energy of the physical footprint is here to stay.
Wonderful, wonderful. Sandeep, there is a global access versus global understanding conundrum. Typically, now most students, actually from India, the numbers are growing every year, are going to study abroad, and as and when they go, it's out of their FOMO or out of the peer pressure or out of the trend, so to say, they get exposed to a lot of global access of where to invest money and all that. So this typically, I see it as an illusion. Whether I just wanted to kind of validate that thought. Global access does not mean global understanding. So what do you think? Is this correct? Because I can go and invest anywhere in the world now, but does it wise for me to invest?
I think at the start of a conversation, Brajesh, you made a wonderful point around the access of information being equally available.
That's correct.
Right? So which means whether you want to get to know about Reliance Industries in India or NVIDIA, which is a large chip maker in the US, you could have the same access of information whether you're physically based in India or the US.
Absolutely.
Right? Now, investing globally versus investing in India may have different risks, may have different opportunities. The question is, what do you want to do, right? Now, India is very fast growing, as we said. We're celebrating India's growth. We are all very proud Indians in this room. At the same point of time, India represents a smaller part of the market cap in the world. And at points of time, whether you are resident in India or you never stepped out of India,
correct,
but you want to be able to build a life corpus outside, you say, listen, I want to be able to invest in storage companies which are doing very well.
Yeah.
Right? Is it a Korean company called SK Hynix? Is it a Micron in the US? Or I wanted to find out a chip maker? Is it NVIDIA? Is it AMD? So there are options which are available in India. There are options which are available outside. You could simplify that with funds. And now Gift City, as I mentioned earlier, is a phenomenal place. So you could actually at Gift say, listen, I've got a fund. That fund should invest half in India, half in the US. And that's possible. You want a fund in India, which is an emerging markets fund, which we again referenced earlier, that may be possible. It is not particularly unwise to have global diversification. It obviously depends on your life end goal. You could start saving up and say, listen, I want to start saving up a little bit every year.
Sure.
I do think that my child is going to study overseas. Let's say he's going to start college in 4 years from now. The fees may be in a different currency than in rupee. And so therefore, I want to start saving up.
Sure.
You could open an account at Gift City and you could start investing from Gift City. It can all be done sitting in Mumbai.
Sure.
Or in Bangalore or in Delhi or in Chennai or wherever in India. Or at the same point of time, you may decide, listen, all my life goals and life needs are around the India rupee underlying and the Indian assets, and that's acceptable too. I think the question is, don't do global because you like global.
Yeah.
Do global because if you want to diversify or because you feel there is an investing case, which is currently not available in India, or you say, listen, I want to be able to have a mix of another asset class in my portfolio.
Sure.
Think of it like an asset class, think of it like an underlying, think of it that less diversifying your currencies, and it's a small. You could be a non-resident Indian wanting to come back to India, and therefore, again, you may want to invest in your home, in the country you're currently based in your host country, but you also may want to start investing back in the Indian rupee or through the gift. And look at the data points. Indians are the largest remitter of money back home.
That's right.
NRI spend back $130 billion every single year.
Absolutely.
At the same point of time, Indians are spending $30 billion outside.
Yes.
So $160 billion of fund flow is happening every single year, and that's wonderful, right? So if we are a highly connected world, and as we celebrated both the EU deals and the US deals, and so the world will remain interconnected. There are opportunities to invest globally directly through other countries. It is through underlying ETFs and mutual funds in India, or it is available through Gift City, which the government of India and the IFSC has set up, and is a phenomenal place to do business.
Very interesting, very interesting. Especially to the students staying abroad. They are into that, kind of an illusion, मुझे सब समझ में आता है. Let me just start doing it. They don't have any, goals in their mind at that point in time. Because you and me have reached to a juncture or a stage in life now we understand. But the people at that psychology, I don't think so.
Starting early is never a bad idea. I started my first stock I bought when I was 12. Did I really know about that company? No. But I did invest in the IPO. But you know what started to happen? Because although it was essentially money saved through pocket money, if you will, 625 rupees was the first investment. But I got intrigued in the world of investing, so I started to read up.
Wonderful.
But it's also given me enough years to make mistakes, and so some of the best investors will start early. So I don't discourage against starting early.
Sure.
At the same point of time, some of the most legendary investors have come through starting early. It is your choice at what time you want to come into the markets. But when you come to the markets, the more you research, the more you get to know about the... See, it's not just a ticker which changes the price every second. It is actually a share of that business or share of that commodity or share of that debt. And as long as you understand the underlying, you're all right.
Wonderful, wonderful. ठीक है. संदीप वापस आते हैं इंडिया में. Here, the typical families are still emotional when it comes to investment. And the usual, kind of investment arenas are gold, real estate, etc. So gold is a gold. End of the day, people who have invested in gold have actually made huge amount of money. But still, the favorite asset class, so to say, is real estate and gold. So in your experience, when you have actually spent quite a number of years of your career overseas, what is the trend there? I mean, do people still go for the emotional or a comfort-based investment versus the outcome-based investment?
So depending on the market, the combination of real estate, commodities, financial investments, it is a combination. Some people will be a little bit more anchored around a particular asset class versus the other, but I think it is a mix around the world.
Sure.
And obviously, these are all very large asset classes. So even in real estate, there's a commercial real estate angle. There is a residential real estate. It could be a primary home. It could be a building to rent out situation. Now there are REITs available, so you could actually invest in a real estate, but through a financial product. Yeah. Commodities go in and out of. They're more volatile. They tend to be a little bit more volatile. some people like buying the physical form of the commodity versus an ETF or versus investing class. But one unstoppable trend is the rise of equities. And I think equities have taken more and more share of the financial investment space, rightfully, right? Because ultimately, what are you doing in equities? You are taking a share of entrepreneurship.
Yes.
Entrepreneurship, as we know, over a period of time, yields better results than static assets.
Absolutely.
And so I think I wouldn't overreact to the last 5 years, 3 years, 10 years, last 6 months. So, as I said, commodities went up, they melted up, and they melted down. If they were a reasonable percentage of your asset investments, you're all right. But what's going to happen over the next 20, 25 years? We're talking about India. We are going to be a much larger economy, which means businesses which serve the Indian consumer and businesses which export and businesses which manufacture and businesses which provide services will grow. And you may want to do that business yourself, or you may want to take a share of that business. You could take a share of that business through direct investing, or through investing through a fund. Or now there are alternative investment classes. So if you look at the portfolio PMS program, the portfolio management schemes, and the AIFs, there are multiple ways to access essentially what's entrepreneurship or credit, right? So you may want to invest in an early stage fund, which may take investments into multiple small businesses. You may take an AIF to a late stage company. You could do a buyout company. You could do private credit, depending, as long as you understand the financial needs. You've had a fair conversation. You understand the trade-off between the liquidity and the returns. You could.
Thanks, Sandeep. I think very, very interesting point. Let's talk about a little bit of a diversification. Now, today we see almost every investor has so much of awareness that plenty of investment options. Okay. Where do you see that this diversification reaches to a threshold when it stops protecting and starts distracting from people to achieve their long-term goals?
As I said, understanding the underlying is important.
Yeah.
So you're diversifying because you're mixing various asset classes. It's all core.
Sure.
If you're a direct investor and you are 100 companies, there's no way you're able to track 100 companies, right? But let's say you had a combination of funds which were not necessarily overlapping and were providing you diversification. That's core. So don't use diversification to avoid making any choices, right? But diversification, as long as you can track it, understand it, control it, track it, monitor it, you could, right? Is there something called too much diversification? It's hard to say that. But at the same point of time, if you had 19 small cap funds and each one of them essentially held 80% of the same company, is what purpose are you achieving by creating a more complex portfolio, which may be harder for you to understand or your family to understand? So that decision is for you to make.
Absolutely.
Also, for example, you're dealing with one wealth manager or two wealth managers, and they understand your portfolio. They know enough about you. They know about your family. But if you split your portfolio by 5 different people, none of them really understand you or your family. Their ability to focus on you and provide you the right life choices becomes harder.
Sure. So in this spree of, literally investing and diversifying, do you see people commonly make some blind spots mistakes?
As I said, the biggest one is investing in things you did not have any understanding of, right? Or invest in when things look very good, right? So this can only go up. The moment you start feeling this can only go up, it's very likely going to go down, right?
And that's a very interesting insight.
Right? Or it's only pessimistic, and life is only bad news. So 2 weeks back, Indian market had done well, the rupee had depreciated, and good news was coming. The economy was still doing very well, but the good news was started to become elusive in the market.
That's right.
And today, the markets have rallied, the rupee is back, and so I think that emotional maturity to see through the cycle is what's more important.
You got to stay balanced, you're saying. Either be pessimistic, not be ultra optimistic, be realistic.
But which also means, Brajesh, that understanding where are you in life and what are your goals. I'll give you an example. Let's say you wanted access to money 3 years from now.
Sure.
but you had a wonderful investment opportunity which would provide you high returns, but likely to be locked in for 7 years. Right? Now, great investment opportunity, but it doesn't meet your liquidity needs.
Absolutely.
Right?
Correct. Yeah.
So it's probably not for you. Right?
Sure.
You are a year away from retirement,
Hmm.
and you're going to rely on your portfolio,
Yeah.
but you're 95% in equities. Maybe not a good idea. Maybe you want a little bit of a debt. Maybe you want a little bit more cash flow in the equation. You wanted to actually, you were due for a transfer and you wanted to stay in another market, or your child is moving overseas, but you have absolutely zero exposure to global equities or global investing opportunities. Maybe not such a good idea.
Sure.
Right? So what is your liquidity need here, right? So if you're a 25-year-old and you're only in debt, maybe it's right for you because you're completely risk averse. But maybe it's you're going to be in the market 30, 40 years. Maybe a higher exposure to equity is not a bad idea. And there's typically the 100 minus age rule, but there's no right or wrong formula.
Sure.
But having the self-understanding to monitor that, and at the other point of time, which is while investing is very important, investing in yourself is even more important.
Absolutely.
Right?
Very interesting point. Yes.
So
self-reflection is very, very important.
And also, listen, so investing is important.
Yeah.
But are you investing in life skills? Are you focusing on your business or your career?
Yeah.
Are you aware of your health? Are you spending enough quality time? Or are you only trying to maximize that 1% return?
Yeah.
And so there is a fine balance. So I always encourage people I work with to say, listen, get this right.
Yeah.
But remember, your family and your personal career and your personal business is also very important.
That's
and
great.
Sometimes more important.
That's great.
So which is why work with somebody who can simplify this process.
Absolutely. So Sandeep, my audience is roughly between 25 to 30 years of age. What is your one correct advice to them? Because which will be like a long lasting, like very difficult to trade off between, the delay in investing or chasing returns or making the first begging stake. There is a different fine, there is a very fine line between the two. So what is your clear advice?
See, first of all, I'm all very jealous of all of you. It's a wonderful age to be in. Full of energy, only the future ahead of you. So congratulations on being on the right age. That's one.
Yeah.
If there's one life advice and one financial thing I wouldn't do in my life is to leverage. It's very tempting, but it's a really bad idea. Right? So that is my only. If there's one advice I want you to remember is, it's very tempting.
Absolutely.
It's very lucrative.
Yeah.
But speculating plus leverage is a very high probability of failure. So just avoid that.
Absolutely. So control that urge somehow.
If you can zeroize it, it's more likely to be a credit. This is a very personal opinion I have, not my employer's opinion necessarily, but I'm saying stay away from leverage.
Yeah. So basically is a relevant and a related question here. So Sandeep, what actually are the qualities of a good investor in terms of, whenever they have to compound their returns? So is it emotional quotient? Is it, controlling that urge or a discipline? What exactly is the right combination of that?
I think staying power here, as long as you remain committed to what you are set out to do and you're not distracted, right? I think you do all right because, as I said, investing is a multi-decade cycle.
Yeah.
The temptations to keep moving on towards the shiniest, brightest, last 12 months, last 3 months, last 6 months, last 15-day return is always high. So greed and fear, two powerful emotions which none of us can completely avoid.
Absolutely.
But as long as you can try and keep greed and fear to the least in your investing cycle, you'll do very well.
Wonderful. So instead of greed and fear, bring intelligence, strategy, and maybe some emotional discipline about it.
Yeah. And, we spoke about long-term investing.
Yeah, that's correct.
But at the same time, you could get stuck in a multi-year cycle. For example, I'll give you an example. The Hang Seng, for 15 to 20 years, almost had a 0% return, right? But smart investors in that market were at that point of time also spread out and taking the right decisions, right?
Yeah.
So there could be periods of time correction in markets. you will face that time correction. You could face it for 5 years. The Nifty may give returns or may not give returns. Are you again in that case globally diversified? You have enough debt, enough equity, enough underlying, and you're all right.
Yeah. So we come to the last segment of the show, Sandeep. So when it comes to the quiet wealth creation, in your own experience, you've seen now the world, and what is the see-through difference you see between India and the overseas markets? And what is the non-financial habit you've actually seen, which actually works, whether it is for Indian families or even overseas families, which creates a very long-term wealth creation,
See, a lot of the wealth creation you're seeing in particularly the US is either a combination of entrepreneurship, or it is actually companies sharing stock option plans or essentially sharing that share of entrepreneurship.
Sure. Okay.
In India, again, you see a lot of the wealth creation through a combination of entrepreneurship and through the grit of moving up in your in your corporate careers. But the best investors, right, people who actually use their careers and also continue to grow, make smart financial choices. So what's your saving ratio? How consistent are you in deploying it to the right asset classes?
Sure.
Is your money working for you, or are you working for money, right? So we are for money, but we should also allow our money to work for you.
That's a great pearl of wisdom, Sandeep. Wonderful. Awesome. Sandeep, thank you so much for spending such a quality time with us. And I'm actually feeling truly blessed after having you onto the show, and maybe see you growing more and more, and maybe see HSBC all over the India now, and
absolutely. So lots new physical places come in, but to the ones, if you have an opportunity to go visit an HSBC branch, the best financial planners, the best coffee sometimes, and these are all beautiful branches. So do spend the time. We recently opened 4, with one was in Lucknow, Amritsar, Indore, and Baroda. So Surat and Nagpur are coming soon, and more and more and more. But even like existing cities, go check out the centers and go have that conversation.
So we are a big fan. My daughter already has a UK HSBC account. She's a big fan, and so we are.
Right.
So thank you once again, Sandeep, for such a wonderful time with you, and I wish you all the best. And thank you once again.
Thanks so much.
Okay. Wasn't it a great conversation we've had? So what we have learned is that India's wealth story will not fail for the lack of opportunity. It will fail only if the clarity does not keep pace with capital. The next 100 million Indians don't need more products. They don't need louder advice. They need better judgment. They need patience. And they need the emotional discipline to think long-term in a world that constantly rewards short-term decisions. Sandeep, thank you so much for sharing not just your experience, but your great perspective, and for reminding us that enduring wealth is built quietly, consistently, and with great intention. To everyone watching or listening, what was the one insight from today's conversation that genuinely changed the way you think about money? Let us know in the comments, and if On the Point helped you see your financial decisions with a little more clarity, make sure to subscribe. No jargon, just clarity. Stay on the point. Thank you.